Alright, today we're talking about the Solo 401k. The Solo 401k is a type of retirement plan for the self-employed that works, in my opinion, better than self-directed IRAs and self-directed Roth IRAs. The Solo 401k plan is the same type of 401k plan you're familiar with. It's the same thing your employer might offer. The Solo 401k, however, can only be implemented by self-employed individuals or small business owners. The business can have no full-time employees except for the spouse of the owner. The business can have part-time employees, however they must work less than 1,000 hours per year. And the business can hire independent contractors. The contribution rules for a Solo 401k are what makes this a very powerful savings tool. For 2008, you can contribute $15,500 to your Solo 401k. If you are age 50 or older, you can contribute an additional $5,000 catch-up payment totaling $20,500. One of the bonuses is that you can participate in profit sharing with your own business. The business can make additional tax-deductible contributions toward your Solo 401k. The business can contribute up to 25% of your yearly salary. The total contributions, meaning combined contributions made personally and by the business, cannot exceed the lesser of $46,000 or 100% of your salary. And if you're age 50 or older, that number goes up by that $5,000 catch-up payment to $51,000. If a husband and wife both work for the business, they can contribute a total of $92,000 to the Solo 401ks, meaning $46,000 for each, the husband and the wife. If the husband and wife are both 50 or older, the total amount they can contribute would jump to $102,000 if they both contribute the $5,000 catch-up payment. Let's look at an example. Let's say Richard and Sharon are both 49 years old. They own a business with no employees besides themselves, which qualifies them to set up a Solo 401k plan. In 2008, Richard's salary would be $60,000 and Sharon's will be $80,000. Richard and Sharon both plan on making the maximum contribution that they can, which is $15,500. In addition, they plan on the business contributing the maximum it can to each of them. Remember, the business can contribute 25% of their salary, so for Richard, he will receive an additional $15,000, and Sharon will receive an additional $20,000. Richard's total contributions to his Solo 401k plan for 2008 will be $30,500, and Sharon's total contributions to her Solo 401k plan for 2008 will be $35,500. Their total combined contributions will be $66,000. Now, if they were both age 50 or older, they could each contribute an additional catch-up payment of $5,000. This would raise their total contributions to $76,000. Let's break down those numbers. Richard's personal contribution is $15,500. To this, we will add the contribution made to his account by the business, which is 25% of his $60,000 salary, or $15,000. Adding these numbers together totals $30,500. Sharon's personal contribution is $15,500. To this, we add the business contribution of $20,000, which again is 25% of her $80,000 salary. Adding these two numbers totals $35,500. Now if we add Richard's total to Sharon's total, $30,500 plus $35,500 gives a total of $66,000. Now let's kick this up a notch. With a Solo 401k plan, you can choose to take Roth status. In other words, you can contribute after-tax dollars to your Solo 401k. This means that when you retire and take withdrawals from your Solo 401k, those withdrawals will be tax-free. With this said, it is now crucially important that you take control of your retirement account and find investments that generate higher returns. This way, your money is growing faster and it is growing tax-free. Now back to our Richard and Sharon example. Had Richard and Sharon set up their Solo 401k with Roth status, the $66,000 would have been after-tax money. What this means is that when they retire, their withdrawals would have been tax-free. Now, a minute ago I said that you needed to take control of your retirement accounts and find better investments that make higher returns. With a solo 401k, the owner of the company gets to choose where the 401k funds will be invested. This is what the solo 401k and a self-directed IRA have in common. So let's take a look at the advantages of a solo 401k, and more specifically, a solo Roth 401k. First, let's look at debt-financed income. This is income generated by your IRA borrowing money to invest. For example, let's say you have a self-directed Roth IRA, and you decide to buy a rental property with it. You find a property that your Roth can purchase for $60,000, but your Roth only has $30,000 in the account. You can borrow the other $30,000. However, you will have to find a non-recourse lender to borrow the money. A non-recourse loan is a loan that you do not personally guarantee. So again, your Roth has $30,000. You'll have to find a non-recourse lender to borrow the other $30,000. Now, your Roth will have to pay taxes on the percentage of the profit that equals the percentage of the purchase price your Roth had to borrow. In other words, because your Roth had to borrow 50% of the purchase money, your Roth will have to pay taxes on 50% of the profits. On the other hand, if you have a solo Roth 401k, you can borrow money to purchase the same house, and there are no taxes paid on the profits. This leads us to using leverage to purchase real estate. Now, what is leverage? Let's say that you have $100,000 in your Roth account, and instead of buying one property for $100,000, you decide to buy 5 properties. You put $20,000 down on each of the 5 properties, and then you borrow the rest of the money to purchase those 5 properties. This means that you are borrowing money to purchase the real estate. This is what leveraging means. This also means you do not need to find a non-recourse lender. Any cash flow will not be subject to unrelated business income tax. Now, what is unrelated business income tax? It is taxes paid on unrelated business income, which is defined by debt-financed income, which is usually in the form of rent, interest, or royalties arising from a financed property. So again, using a solo 401k, you eliminate any unrelated business income taxes. Next, let's take a look at capital gains. Capital gains is the difference between what you paid for an investment and what you received when you sold the investment. If you made a profit, you received capital gains, and typically you are taxed on capital gains. Now, the great thing about a solo 401k is that taxes on capital gains are deferred. And this is very similar to a 1031 lifetime exchange. The taxes being deferred means that you can take the profits from the sale of an investment and roll the entire amount into the next investment, and not having to pay any taxes on those capital gains. When you finally take withdrawals from your solo 401k, you'll be taxed at that point. This is like an interest-free loan on the money that would have been taxed. You get to keep and use the money that would have been paid to Uncle Sam, which will allow you to buy more investments. Let's take a look at what I consider the most powerful wealth building tool out there: buying a business with your solo Roth 401k. Unlike a traditional self-directed IRA or self-directed Roth IRA, a business owned by your solo 401k can actually hire you and pay you a salary. In traditional self-directed IRAs, this is considered self-dealing, and you would have a tax nightmare on your hands. This little bit of knowledge is one of those closely guarded secrets of the wealthy. With a solo 401k, you can actually borrow money and not have to pay any penalties or taxes. You can borrow up to 50% of the balance and no more than $50,000. The loan typically must be repaid within 5 years. You can borrow money to buy a home, and then you are allowed 10 to 15 years to repay the loan. Finally, let's look at the biggest advantage of the solo Roth 401k: income limitations. With a traditional Roth IRA, your annual gross income must be less than $166,000 if you are married filing jointly. This means if you make more than that, the IRS does not allow you to have a Roth IRA. If you are single, your annual gross income must be less than $109,000. With a solo Roth 401k, there is no limit on yearly earnings. This means you could make $250,000 per year, and you're still allowed to have a solo Roth 401k. To learn more about how the solo 401k can help you and work for you, sign up for our 3-day training. Even if you are not currently self-employed and you actually have another job, there are ways in which you can use a solo 401k to help you save for your retirement and take control. Again, for more information, sign up for our 3-day training. This concludes our presentation on the solo 401k.